Well, we've got really a two-tier growth story in China at the moment between basically the new economy, so things relating to the installation of renewable energy, the EV rollout, building the power grids, all of the kind of new economy stuff that she's really focusing on driving China's modernization, versus the old economy, things like the infrastructure build out, the housing market, you know, uh, areas that we focused on for the last 20 years in commodity markets that have given us huge prices for things like iron ore, especially. But those are now in contraction, right? Because she's really clamping down on China's debt issues. So big clampdown on LGFEs, local government spending, and that's really hurting things like the infrastructure spending. So you look at cement demand, for example, is running down double digits at the moment, whereas copper demand is still growing 3 or 4% this year because of its exposure to that green energy story. So this is quite unique for commodities. It's really the first time in 20 years where we're seeing a real divergence in the
And
demand
that,
trends in China. It's no longer a rising tide lifts all boats.
and Ian, my worry is that if that trend is structural in nature, as you point out, because as you're talking about it, it seems like it's more deep-ended and that it is more to do with the rebalancing and improving the quality of growth in China, then what does it mean for a commodity player like Australia?
Yeah, so that's the key question, really. It's about winners and losers there. So the infrastructure and housing, obviously massive consumers of steel and cement. So iron ore, very exposed to that story. Whereas metals exposed to the green energy story, especially copper, some of the other green energy metals, lithium longer term, they can still see a lot of demand growth out of China in the next decade. So prices for those, we still need to incentivize new mine supply. But it's really iron ore and steel, which are the ones that are really suffering this year. And structurally, that's very much going to continue.
Yeah, I'm curious, when we talk about things like copper, we have seen those prices coming off from those highs. I do know that there is some inventory build-up over in China. I'm wondering if you see that the market is perhaps a little bit too bullish on China, given sort of the market dynamics within the country, but also given what the data is telling us about the demand story.
Yeah, so the prices are kind of really looking at where is the market going in the future, and they're for once doing a job of kind of pricing ahead. And the price today looks very high on paper versus a lot of the data, but we can certainly see that we'll get there in terms of the market tightness, because we know the big problem in copper today is mine supply growth, right? That's really, really tight. Globally, mines having a lot of problems. I think the biggest producer in Chile, Codelco, just reported their lowest production in 3 years. There's a real lack of mine supply of copper. So China's concentrate imports last month were down double digit. Ultimately, that means China will have to produce less copper in a couple of months' time. So right now, they've still got a lot of refined metal inventory, kind of an overhang of the big production last year, but the renewable energy build out, all those green stores are consuming the copper week by week, and eventually those inventories will start to draw. And then with the lack of mine supply growth, and when we look at where's the copper market going to be in 3 to 6 months, it clearly looks like it's going to be very, very tight. So that's where the prices have been quite volatile recently, shooting up an expectation of the tightness and then pulling back a bit when people look at the current market and think, oh, actually, we're not there yet. It's not quite tight enough. But structurally, we know there's a real lack of copper coming out of the ground, and that's going to become an increasing issue.